Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is our great friend Rafi Farber from the Endgame Investor. Rafi, always great to see you.
Hey, great to see you guys too. I'm excited to be back.
So Rafi, the platinum market, inventory's been in big decline, primarily because a lot of platinum comes from Russia. And I know platinum's used in catalytic converters and things like that. But the supply's been draining a lot, and we're starting to see perhaps a breakout in the platinum price. And I know you had some thoughts about this, and I wanted to give you an opportunity to talk about it. Is this for real? Is this and this is related to silver because it's a precious. Platinum is considered a precious metal also. Is this like the same sort of concept, a platinum squeeze that we might be seeing happen?
It could be. I'm not like a platinum analyst or a platinum follower per se. I don't check the price every day and know the inner workings of the platinum market. What I can say is that platinum is I'm a monetary analyst. I'm not so much of a silver as an industrial commodity analyst. I'm a silver as a monetary commodity analyst because I understand nature of money and the return of silver to the monetary realities. That's what I really focus on. So linguistically, you could say platinum means little silver. That's the meaning of the name. And it is a semi-precious metal in terms of, more accurately, it's a semi-monetary metal. If you read the literature on the hyperinflation of Weimar, you'll find that, in the late 1922, early 1923, the German police were, just confiscating metals, which included platinum from people who were using platinum to trade. Those who didn't have gold or silver, some had platinum. They were using that to try to hang on to some of their value. So yeah, it is like a quasi-monetary metal, but it's not fully there. So that means the liquidity is going to be less. But what is going on in platinum? The supply of platinum on the COMEX has gone way, way down since the lockdowns, that spike of all the supply during the lockdowns. And there's about, I think it was like 1,500 or 1,400 contracts worth of platinum that are available for delivery in the registered category. Not that much. There never is that much. But tonight starts deliveries, and I think there's like 3,600 contracts still open, and only about 1,400 or 1,500 contracts worth that are available for delivery. So there's going to be, there has to be at least 2,000 contracts that close out tonight, or the amount of registered platinum available for delivery will be trumped by the number of contracts that need to be delivered. And that happened in silver once. That happened, I think, in July 2020, right before the big top in around August 2020. So we could see a huge jump in platinum if contracts don't roll over tonight, which we're already seeing. I think it's up like $50-$60 tonight. I haven't checked the numbers, but yeah, it could be, there could be a squeeze. Usually these things all roll over, but one day they won't. One day they will not. We saw it in nickel. We're going to see it in platinum. Then we're going to see it in silver. And finally, we're going to see it in gold. And that should be the collapse of the dollar.
Yeah. There's two main sources for platinum in the world, and it's primarily from Russia and South Africa. Those are where the two biggest countries, the deposit, at least the currently mined deposits are. So, the theory is Russia's a little bit interrupted, or it's just more difficult to get it out of Russia. And that's why the physical supplies on the exchanges are being drained so rapidly. So that might have be a piece of this puzzle. But yeah, it'll be interesting to watch over the next week or two what happens to this platinum price and any other metals. I'd love to see it, have I own one platinum stock, Impala, but it'd be interesting to watch. So Rafi, one of the things that you've said in the past is precious metals typically bottom before other commodities, and I guess you're referring to base metals or energy, or what are you referring to for that? And what's the trend right now that you're seeing for silver and gold related to other commodities?
What I'm referring to is consumer commodities. It could be energy, base metals, agriculture, all that stuff combined. And what we've seen, what I've noticed since 2000, 2001, when the current gold and silver bull markets began, And there have been intermittent bear markets in between, from 2011 to 2015, for example, or from August 2022, it looks like 2022, around September 2022. There have been little bear markets in between, but we've been in a secular bull of precious metals since then. And what I've noticed is that every time that there's a major bottom in gold and silver, which don't bottom at the exact same time, but they bottom close together, the bottoms in gold and silver always happen before consumable commodities. So let's say the CRB index, and I'll share my screen here and I'll show you what I'm talking about. So here, this first chart, this is a chart from 2001, right? So you see in the candles here, you have gold bottoming, and here where my cross is circling, that's February 2001. I think gold bottom here is like 253 and silver bottom very close to that. So the gold bottom happened here in February 2001. And now here, this line, this is the CRB index. That's a basket of commodities, including agriculture, energy, base metals, those kinds of things. And the bottom here is in October, late October 2001. So the buffer between here is February to October, let's say 9 months, right? So consumable commodities bottom 9 months before gold. And now if we go to the next chart, this is 7-8 years later, during the 2008 bottom. And you have here the gold bottom in late October 2008. And here's the line of the CRB. The bottom here looks to be in early March 2009. So the buffer there is October to March. That's about 5 months. So we start with 9 months, and then we go to 5 months. Now, the next chart here is the bear market bottom in 2015 in gold, right? It bottom here in December 2015, December 5th, I think it was 1045 or something. And the CRB index consumable commodities bottoms in February 2016. So we have a buffer. Gold bottoms first, gold and silver bottom first. And then you have the CRB bottoming in February. That's about two months now. It's getting shorter, right? And now you have the most recent bottom, not counting the one in 2022, which is preliminary because we don't know what's going to happen tomorrow, but it looks like a bottom is in. March 16th, 2020, gold bottoms at $14.50, silver bottoms about $11, I think I remember correctly. And remember, late April, when oil was falling and falling into negative territory, oil hit, I think, negative $35 a barrel or something in April 2020, in the middle of the
should have
lockdowns.
refilled the Strategic Petroleum Reserve back then at negative 30, right?
Yeah, they would have been paid to it. That's actually when they should have done it. Yeah, but they're not. They're stupid. So anyway, so the buffer here between the gold bottom and the commodities CRB bottom is like 3 weeks. It's getting much. It's still, the gold is still first, but the buffer zone is now less than a month. Right? And now if we assume that the bottom in gold and silver came, the bottom gold was, I think, November, and I think it was like 1618 or something, right? And the CRB bottom way before that. And about it was early September, the commodities bottom, the CRB index bottom. So now, assuming these bottoms hold, we have a bottom in the CRB before we have a bottom in gold. And so not only the buffer is not only close, it's negative, right? So this is not just it's not just, oh, this is an interesting chart pattern and what we can make of it. There's a possible logical explanation for this, coming from the Austrian school angle of seeing how economics works, right? So when you have the beginning of an inflationary cycle, by inflation I mean the inflation of the money supply. I'm not talking about consumer prices or anything. I'm talking about the actual inflation of the money supply. So when the inflationary process starts, it starts way deep inside the monetary system that's very far away from consumer prices, very far away from consumer goods. So the inflation doesn't infect the consumer sector very quickly. It always lags. The new money that's printed, it takes time for it to go from the banking system all the way down the structure of production into the consumer sector. So initially, when the inflationary process starts, it's going to take some time. So there's going to be a lag between gold and silver bottoming, which is the monetary commodities, which should be the first to be affected by a monetary inflation. And then eventually, the money will filter through to the consumer sector. And then the consumer sector will, and then the consumer sector will bottom and then reverse. That's symbolized, I say, the consumer commodities. Now, as the inflation progresses, as the cycle progresses, you have to get closer and closer. You have to dump the money closer and closer to the consumer sector, because the banks are running out of space on their balance sheets, and they have so much reserve. So we saw in 2008 there were bailouts, right? There were $700 billion bailouts in the TARP or whatever, and there were $16 trillion bailouts in the central banks. So it was still deep in the monetary system, but it was getting closer and closer to the consumer sector. And then in 2020, you have the inflation that's almost directly into the consumer sector itself, because you're paying people checks from the government to go buy their groceries and pay their gas bills and pay their rent, right? So the bottom between gold, when the money infects the gold sector, and then from the time it takes to filter into the consumer sector, is very, very short. And now we're seeing a bottom in consumer commodities before we're seeing a bottom in gold, which means it's affecting the consumer sector a lot faster than it ever has. So I think from an Austrian school perspective, this means that we're very close to it means the next round of inflation, when the Fed turns around and says, oh, we can't do this anymore because all the bubbles are collapsing. They're not going to use those words, but that's basically what they're going to say. We have to save the banking system, whatever they're going to say. It's going to affect the consumer sector very fast. And at that point, you have a switch when the public wakes up and says, okay, we got to get rid of this. And we all know what happens then. We've been discussing it for months, for years. We're waiting for that moment. Is it going to happen in 2023? I hope so. I think it's very possible. Do I know for sure? No, I never know anything for sure. But I know the end game is inevitable, and it's coming, and it could be this year.
Well, that that reminds what you just said about something's going to break. The Fed's going to have to get involved with these things. I just saw this video that this is from the FDIC from a November meeting. But they're actually talking about the financial system collapsing. The FDIC, the Federal Deposit Insurance Corporation, they're actively discussing how they're going to handle this, because they're expecting massive amounts of bank failures in 2023. They're actively preparing for these things. And I just found it very interesting that the people in the know who have to deal with these crises, they seem to be, I know I read also an article recently that they're staffing up their department that specializes in bank seizures and bank shutdowns.
Really?
That department of the FDIC has not been fully staffed since, going back to, I think, 2012. We had that series of all those bank bailouts in 2009 and 10 and 11, where they seized a bunch of insolvent banks. And since then, haven't had to do that very much. Well, they're preparing to do it again. Wow. And I question how when this starts happening, it's going to be impossible for the Fed to continue their current quantitative tightening policy, their high interest rate policy. As soon as this crisis starts, whenever it is, and the FDIC is preparing for it now, that's when the Fed's balance sheet explodes from 9 trillion up to 20 trillion. Yep. The level of printing they're going to have to do to reinflate the economy and bail out all the banks again. And then Congress is going to start spending crazy money in the form of stimulus, unemployment checks, more food stamps, more stimmy checks. I mean, it's going to be a $5 trillion to $10 trillion orgy of stimulus and bailouts. We have no idea, how big it's going to be or the manner it's going to appear. But would you agree we're probably going to see a $20 trillion balance sheet for the Fed when it happens?
Yeah, I mean, look, conceptually, I agree with you. If the dollar system, the fiat system, survives another round of this, which I don't think it will, then yeah, I guess the nominal number we would reach is somewhere around 20 trillion. If you're going to follow, it's not rocket science, right? You follow an exponential growth path. That's how every inflationary system starts and ends, right? It's an exponential growth curve. So that's what the balance sheet would have to do. The question is, once we reach 20 trillion, the question is, what is the gold or silver value of that balance sheet, right? is it still going to be, is the dollar and gold or silver still going to be exchangeable? Are they going to have a rate, right? So if the Fed goes to 20 trillion and but then the value of the bonds in their balance sheet goes to zero and the only thing left is the gold left in Fort Knox, assuming it's even there, then these numbers are meaningless. Like at some point, it doesn't matter what the number is because the number doesn't mean anything, which is the universe you enter into when you hit hyperinflation. And because we're in such a digital world, we're not in Weimar where a government has to actually print up the physical paper and then hand it out to people manually, like put it in their hands, right? We're in a digital world where everything can be done in a split second. The inflation of prices and the money supply can happen instantly, right? So yeah, we might reach 20 trillion, but by then it might be over.
Well, I think I heard someone say, maybe it was Dave Kranzler or someone like that. When this is all over, we're not going to be measuring gold and silver in dollars anymore.
No, definitely, yeah.
It's like they're all going to infinity at that point. In a worst case scenario.
You're going to be measuring goods. You're going to be measuring actual goods that people need in gold and silver ounces.
Didn't they do that in Venezuela or Spain? They in gold flakes. There was some stores, grocery stores.
I saw that. That was Venezuela up in the mountains of Venezuela or something. They were doing commerce in gold flakes or something.
Yeah,
right.
Crazy.
Even in Venezuela, though, right? If you're going to take the perspective of a different country that has a hyperinflationary situation locally in their local currency, they can always go to the dollar if they need to, because the dollar still works. The real interesting case is when the dollar itself hyperinflates. You can't have any other country going to any other currency because every other currency is based on it. So then you have to go back to actual gold and silver.
That's okay. Let's say confidence is lost in the monetary system. Dollars in severe decline. Euros and yen also. British pound also. They're all sort of losing confidence because everyone's printing out the wazoo. Inflation's even. It doesn't even have to get to hyperinflation. If you just have a couple of years at 20% plus or 30% inflation, I think Willem Middelkoop just referred to it as superinflation. You know, several years in a row at 20 to 30% just completely destroys the economy, destroys people's life savings. And however this plays out over the next, I think it's within our lifetimes, whether it's, in the next 2 or 3 years or whether it's 10 to 20 years, I think it's already inevitable. It's already baked into the cake, and there's no way to stop this. We've crossed the Rubicon in terms of the debt levels relative to the size of our economy. And the only strategy the central banks seem to have is they only have one playbook, right? They got to print. They don't have another solution.
Or roll out a CBDC.
They don't have other tools, right? Their solution is, all right, well, the dollar's done. Well, hey, let's do that CBDC thing. That'll fix everything, right?
I do have what to say about that. The CBDC. Okay.
Yeah.
Look, CBDC is I do not challenge the assertion that CBDC would be a horror show for all of humanity, right? It would be an absolute horror movie.
Right.
For reasons that I'm sure the audience here understands. Everything trackable. The government knows everything that you buy and restricts you from buying things that it doesn't want you to buy, and times a suicide circuit on the currency or whatever they do. It's a horror show. However, it's impossible. It can't replace the dollar and reset the system, because if you think about how they would institute it, if you have, let's say, $10,000 in your bank account, right? And then they say, okay, we're going to move to CBDC now. What are they going to do? They're going to replace 1-to-1 or 2-to-1 or 5-to-1 or whatever the ratio is. Doesn't matter. Right. They're going to replace it equally for everyone on some ratio. And instead of dollars, you're going to have CBDC, which is basically, from a monetary perspective, it's the same thing as logging into your account on the internet, logging into your bank account and seeing a number on your bank account. It's it's data. It's ones and zeros that you're looking at. There's no difference between that and an Excel spreadsheet that you call CBDC, except CBDC is more trackable. but it's
Right.
based on the price system that existed before it. So it's the same inflationary path that has to be taken by the one before it. It's not a new thing.
All these discussions about, let's do a CBDC. None of them ever take into account, oh, well, are we all right? If we're going to go back to if we're going to do this, are we going to link it to gold again? Require 40% gold backing of the number of CBDC units? No, that's never part of the discussion.
Well, then they can't print it if they're not. Then if they're going to back it by any percentage of gold, any fixed percentage of gold or silver, then they can't print it. I mean, look, whether they admit it or not, all dollars are backed by gold, whether they want to admit it or not. They will either back it at a fixed rate and be honest about it, or they won't back it and it'll be backed by the market. That's what the exchange rate between gold and silver and dollars is right now.
I'm hoping that when this whole CBDC thing comes down and we're tweeting about it, Elon's following the Wall Street Silver account now. I'm hoping I'm not going to bug him about it privately, even though I could.
It's like, hey, buy silver now.
I can send him private messages, but I'm not going to abuse that or anything. But I'm hoping that he comes out sort of and draws some attention to that subject. Also to, if we are going to do a new currency through a CBDC, link it to gold. There has to be limits on the next currency. If we just do the same thing that we're doing with the current currency, we're just going to have the same problems again. I think that's the bottom line. So, anyways, Rafi,
the fact that currencies are short term is inherent in the name. It's current. Then they die.
Yeah. Well said.
Well said. So till next time, Rafi, thank you very much, and we appreciate it.
Thanks for having me.